Hey everyone, John Calicchio at Icon Capital Group. I'm back with you today for part two of a series on round-the-clock trading and some of the pros and cons. Let me first say that it has been a very long week. I was in Toronto with our partners, MedTech Syndicates, for the successful launch of our first two Reg CF crowdfunding offerings. The event went very well. Toronto is a beautiful city. Although it was covered in snow while I was there, and it was very cold, and I missed my connection on the way back and got stuck in Chicago overnight. I never learned my lesson not to fly through Chicago in the winter. And then while I was back here in beautiful Southern California, Monday night, I did have my heart broken as my beloved Miami Hurricanes were stopped in their attempt to win a sixth national title, lost in the championship game to the Indiana Hoosiers. It was a great game. If you're a football fan, if you're a Hurricane fan, it sucked. Anyway, I still love my Canes. I figure I would represent here today and look to next year and Cane for life. It's all about the U. Anyway, back to more important things. A little discussion on the pros and cons of 24/5 trading, round-the-clock trading, RTC trading as we refer to it. Some of the pros. Actually, you could. It allows you to react to news in real time, which is great. If you're an investor, you have a portfolio and you want to react to macroeconomic news or geopolitical events that may affect the markets overall. It gives you greater flexibility. From a time flexibility, it will encourage more international users so that you don't have to get up for the hours of the market right now, which are basic market hours 9:30 to 4 p.m. on the East Coast. You don't have to wake up in the dead of night in order to trade if you're in Far East. You don't have to trade through the night if you're in Europe. Another thing is that you've got more trading opportunities because, again, of geopolitical events, macroeconomic events, opportunity to maybe make more money trading in markets that are continually open and reacting to those events that occur to find price discrepancies and trade. The global market integration is definitely a key of the major U.S. exchanges to become more global, and you've got a potential for better price discovery, but we're going to address that in a second because that's one of the cons. You'll have lower liquidity outside of peak hours, especially while adoption is going on. As with any new change in a format, adoption is key and critical because you need people in order to trade, to make markets. So what you'll wind up having is wider bid-ask spreads and lower volume, which is lower liquidity. Now remember, volume is not liquidity. Volume is a number. It's the amount of shares traded. Liquidity is the ability to move a block of stock with minimal price impact. That's the definition of liquidity. In these markets, in the beginning, with slower adoptability, you will have less liquidity. The question of whether there'll be the same type of orders in these extended hour or these additional market hour markets, whether you'll have stops, whether you'll have limit orders, whether you'll have trailing stops, trailing losses, those are the things that you would need to consider that could be a con in those extended additional market hours. Pricing and price uncertainty, execution uncertainty. Prices during extended hours may not reflect what you see during normal business sessions. And again, part of that is back to liquidity and price discovery and wider bids and wider spreads. One of the bigger challenges to the regulators is operational and infrastructure challenges. You will need systems that will operate on those additional hours that operate now during the traditional hours in order to look for market discrepancy. You'll have to look for market manipulation. You will need coding in order to capture times on a time and sales to a consolidated tape. And you will have to have additional compliance restrictions and governance in order to look out for the trading to maintain fair and balanced markets. That is going to be a cost to firms that are going to offer it. Where that cost is going to be expanded to, it's going to come to you. At the end of the day, the cost always slow down. If you have a question about how things work, real simple, follow the money. So who's it might going to benefit? I think at the end of the day, it's going to benefit active traders. They'll be able to react more immediately to changes in the market. National investors in different time zones will have the ability now to trade U.S. markets on their own hours. And I think that for the algorithms and those that can spend the money to design these algorithmic systems, I think there'll be an advantage there because I think the advantage will be to take advantage of price discrepancies and arbitrage situations. It's going to be less ideal for the beginner who's not comfortable with low volatility, low liquidity, and wider spreads. I think that is going to be a challenge for beginner traders and maybe something that they should stay away from until it becomes greater adoption in the marketplace. It's less ideal for long-term investors who build out portfolios, really don't need to trade minute by minute. You're building out a portfolio to generate returns over the long run, and daily trading of that portfolio is probably not necessary. And if you don't have strict risk management rules in place, the wide swings, the wider spreads, the potential volatility in those markets might not be suitable to your tastes. So that's just a quick little pro and the con of what round-the-clock trading could be. Our next series, we're going to talk about who really benefits from round-the-clock trading. It's an answer many people might not like and might not want to hear. It might upset some people. What else is new? But it's true nonetheless. So join us the next time. I appreciate you being here. Go Canes. Have a great weekend.